What's going on? Welcome back to Financial Journey. So today I wanted to play this webcast for you. It is on implied volatility associated to options and what that all kind of means altogether. You guys know me. I like to educate as best as I can, and this is why I do have a lot of different brokers, because you have access to a lot of these webinars. So I wanted to play this for you, and for those of you that are interested in learning a little bit more in options, or if you've been dabbling, this is a must listen. So whether you're just playing it in the background or kind of pay attention, if you guys have any questions, let me know in the comments below. I can definitely kind of address that. But with that said, appreciate all of you guys watching.
Hey everyone, my name is Jeff Praisman with Interactive Brokers, and it's my pleasure to welcome back for our monthly webinar series with Market Chameleon, 𝗪𝗓𝗓𝗪𝗓. Hey Dimitri, how are you?
Hey Jeff, how are you? Thanks for having me.
I'm good. I always love having you swing by and do our once a month session on options. And today, can you tell our viewers what we're going to talk about?
Yeah, so we're going to talk about implied volatility leans when we look at options quotes, and it's kind of like it's a metric that we look at. I think it's maybe a little bit unique. I don't know, a lot of people talk about it out there. I'm going to give some examples of what an option volatility lean looks like, what it could indicate, and how traders can benefit from detecting option volatility leans. And I'm going to move on from the disclosure here. And what we'll do today is we'll talk about what is an implied volatility lean, how as a trader you can detect it and the benefits of an implied volatility lean. Then we're going to go to the Market Chameleon website on the options chain and show examples and what it actually looks like. And then we're going to leave 20 minutes at the end just for questions. So let's start out with an implied volatility lean and why it matters. And it's an implied volatility. Let's just start out. What is an implied volatility? And it's a key factor in options trading, and it's a way for traders to really compare option prices on a relative basis. Because if we look at option prices, we have different options. We have different strikes. We have different expirations. We have calls. We have puts. We have bids. We have offers. And how do you compare those to each other on a relative basis? Well, one way is we could look at the option pricing model and convert those prices to its implied volatility. And once we can convert the options to its implied volatility, then we could make relative comparisons, which option is priced higher relative to a different option in terms of its implied volatility. So then once we convert those prices to their implied volatilities, then we could also detect a lean in a quote. So a quote is, you have a bid and an offer, right? And if we look at the bid and an offer, we could also look at the bid implied volatility and the ask implied volatility. And then by looking at the surrounding data, we could see if there's a lean one way, on the bid, on the offer, or maybe on both, okay? And that allows us, as we'll see later on, it allows us to perhaps find better trading opportunities or just get quick insights what's going on in the markets, okay? So to get the implied volatility lean, you need some tools to detect it, okay? It doesn't just like pop out. You need some tools to kind of convert it to the implied volatility, and then to detect that, oh, here's a lean on the bid, here's a lean on the ask, or maybe it could be on both sides. So how do you identify it? And to do that, what you will see is we'll need to also look at the surrounding data with the options that are around it, maybe the strikes above, the strikes below, the puts. But what we'll do is look at the surrounding data, and then we'll be able to see if there is a lien, first we could look at even the bid-ask spread. If the bid-ask spread relative to the bid-ask spreads with the surrounding options looks tighter or wider. But even if that happens, how do we detect if it's tighter? Because it could tighten up on the bid side, tighten up on the ask side, or it could do it on both. So that's what we're going to be doing, is comparing a quote with the surrounding data, so we could detect if there is a potential lien in one of the markets. Okay, and what we're going to do is we're going to look at it on an options chain, and this allows you to quickly scan with your eyes and detect where on the options chain there perhaps is a lien, or there could be multiple liens on an options chain that could present you even a whole different opportunity rather than just one quote. And we'll discuss that as well. So what causes the implied volatility lien, right? What are the factors that contribute to it? Well, one is, if we look at markets, bids and offers, we know that every exchange has dealers that have to provide bids and offers and quotes. It could be a specialist, a lead market maker, or other market makers, and they have an obligation to continuously provide quotes, bids and offers. And it's possible that there's a particular option that a dealer is interested in, either to maybe reduce risk or position, or to increase their exposure or position, and they could put in a lien on their quote, like a pump, right? So they'll say, I'm interested in this particular one. They'll put in a lien to better the market, so they're the best bid out of all the broker dealers, let's say. Another thing that potentially could happen is that there's an order type, could be from a proprietary trader, it could be a customer, and they put in a streaming or pegged order. So it would be like an implied volatility. Instead of putting a resting order, I want to buy this at $1, you could put in an order, I want to buy this option with an implied volatility of 20 or 21, let's say. Well, when you do that, if you have access to that type of order, that order is pegged to the stock price, because as the stock price moves, it's a derivative. An option is a derivative. The option price itself will have to get recalculated based on the implied volatility condition that you put in. So there could be a pegged order in there that will move along with the market, but it improved the market, and it could be coming from a proprietary trader or a customer who has access to that type of order type. It could also be a resting order, limit order. Let's say you have a market, where there's a bid of $1, an ask of $1.20, and if somebody places a limit order at $1.15 or $1.10, well, that's a resting order, but it tightens up the market, right? You'll tighten up the market on one side, the ask side. Or you could go the other way, tighten up the market on the bid side. And it'll be a resting order, but that resting order, because it tightens up the bid-ask quote, it'll look like an implied volatility lien, right? And of course, it doesn't only have to be on one side of the market. You could have a lien on both sides of the market. We'll see if you can detect those today as well, where you have buyers and sellers that are looking at a particular option. Maybe there's a lot of trading going on, and they're both squeezing in because you have two different opinions there. And, if they don't match up, they could squeeze the market on both sides. So the key benefits of the lien is one, if you detect a lien, a lien, usually what it does is it tightens up a spread, right? It tightens up the market because somebody is either stepping up or stepping down to try to signal to somebody they're interested in, buying it or selling, getting a better price, and it'll tighten up the market. So if you're looking on the other side of it and you detect a lien, it could perhaps give you an opportunity to get a better execution. So if you're looking to sell something and you could detect that there's an interested buyer somewhere, well, you guys could negotiate for a better price, right? So it could potentially improve, the execution that you're seeking. And another opportunity is for spread traders, and we'll talk about that. But if you're perhaps looking to do a spread and you could get a better execution on one of the legs, or maybe perhaps both of the legs, and knowing where those liens are, could really, help you perhaps gain a trading edge by detecting those liens. And then the third benefit is that even if you're not trading, by observing the markets and detecting liens, it's another piece of information that will help you understand what might be going on in the markets. Where is there perhaps a demand or supply or something out there where people are, targeting certain options, and what are they doing and which side are they coming in? How much of that volume is, part of a lead? So those are the types of things that could benefit traders by detecting those implied volatility leads. Now, when we talked about the better executions, and I think maybe I already covered this, but one is, you're going to perhaps get a narrower bid-ask spread. If you get a narrower bid-ask spread, then of course you have a better opportunity to get a better execution, because the wider the spread is, the harder it might be to get an execution, closer to maybe a fair value or midpoint. But the narrower it is, the better your execution. And that's how you could take advantage of an improved market quote. So it could be on one side or the other, or both sides. So for example, if you're a trader and you're looking to buy an option, all right, well, you would want to look for somewhere where there's an implied volatility on the ask side. So if something narrows, right, let's say bid-ask quote narrows, well, you would want it to narrow from the ask side if you're looking to buy, right? Because if it narrows from the bid side, well, that's not a real improvement for you, because you're still paying that ask, right? You just know that maybe somebody else is also interested in that option, which is also the information, because now you have competition. Or on the other side is, if you see that somewhere there's an implied volatility on the ask side, that might be an opportunity for you to get a better, relative value, or better execution. Another benefit is just spread trading. Maybe you're not interested necessarily in buying or selling an option, but you may be looking for a spread that may line up, because you have two different options. Let's say a vertical spread where there's a lien on the ask on one of the options, and then you find another option where there's a lien on the bid. Well, it could line up where that could make it an interesting opportunity for a spread. It could be a vertical spread, it could be a time spread, it could be other types of spreads. But when the markets all of a sudden, line up, then you can create a strategy based on, what you're seeing on the board, what's on the options chain. So it doesn't have to be just one single option involved. It could be multiple legs involved that present an opportunity. And then just understanding, when we're talking about just understanding the dynamics through IV leans. So it could provide you just with insights. You open up the options chain, what's going on? Oh, well, here's an IV lean in this upside call all of a sudden. So you see this big pump in the implied volatility, and you're seeing an unusual amount of trading volume. That could indicate that there's some kind of demand out there for a particular option, something maybe to look at or something more to investigate, something to consider in your overall, research and assessment of the options trading volume. And it could perhaps also just reveal potential demands or market sentiments based on how those leans look across the board. Are you seeing some kind of a pattern or some kind of like strong demand, and it could even be along the horizontal or vertical curve that's influencing the skew. So that's another benefit, is just to understand, why the markets are where they are. We could also look at it from a historical perspective, just to understand maybe how, the current positions that may have built up in the open interest, what might have happened, to cause that increase in open interest. So if we see a big open interest maybe on a particular option, or that changed or is building up, well, we could go back and look at the previous day's trades and look at what was happening during those trading activities. And if there's a particular lean associated with the trades, then it could indicate that, somebody was stepping up, on that option, trying to, perhaps like accumulate that option for whatever reason, wanted to build up a long position or implied volatility, but that could just reveal a little bit more insights how potentially we got to that increase in open interest, or an unusual increase in open interest. So it's just another factor or another metric to use in that analysis. All right. So key takeaways. The implied volatility leans, they're good to help with the execution, opportunities to improve or get better quality executions. It could potentially also be used for spread traders and to get deeper insights into the markets. And of course, like anything, implied volatility lean is just another thing in your toolbox to help you with trading or answering questions or finding opportunities, but there's also doesn't eliminate all the other risks of trading options. You still have to go and look at market news and events, and maybe even an implied volatility lean could be explained away because of the current news or events where, perhaps somebody's doing something because there's some news out there or news about to come out, like an earnings or something, and then it'll explain away, perhaps what's going on. Obviously, there's always trading risks with options, so you still have all those risks with options, with liquidity, price volatility, time decay. Those don't go away. And when you detect a lean, you might not have perfect information, so you don't know necessarily if there's somebody out there who does have more information out there and they're acting on that information that might not be accessible to you, or you haven't seen that information. So we look at it, number 4, it's from a holistic decision making, right? We look at it from a broader view of strategy of, how we could use this in our toolbox to help our trading, factoring in all the other things that go into trading with risks and news and risk management and so forth. So key takeaway, it could help improve insights into trading, but there's nothing there that eliminates, the need for, thorough risk assessment, risk management, and so forth. So now what we're going to do is just go and look at some examples on an options chain. We're going to see if we could get some insights, maybe analyze some trading volume. Okay, so let's come out from here, and I'm going to go here to an options chain. So I put up Tesla options chain. This is from today. I put it up here before we started the webinar. What I'm going to do is just close this menu to the left-hand side to expand the screen. And here we see this is an options chain. We got the calls here on the left-hand side with the bids and offers. We have the puts on the right-hand side with the bids and offers. These are the strikes in between. And what you'll notice next to the bids is we have these implied volatilities. These are the implied volatilities that correspond to the bid. Then we have these implied volatilities that correspond to the ask. Same thing on the puts. And when we look at these implied volatilities, remember we're discussing, this allows us to compare the relative values, right? So a 63.4 volatility in this bid is higher than a 63.3 volatility in this bid. This is a 63.5 volatility, which is higher than this and higher than this. So now, on a relative basis, we could compare the options based on the implied volatility of that option, based on the option price and its implied volatility. And what you'll notice here is some of them we have highlighted in white versus this green. And this one that's highlighted in the white color is an implied volatility lean in that option. Okay. So let's just take a look at this one in particular, 63.5. Why do we think that there's an implied volatility lean in a bid? Well, we see that the option below, the implied volatility is 63.3. Then we move up to 63.5, but then the next option is 62.8. So these strikes, they're close together. They're, one strike apart. So this one in between, definitely on a relative basis, is higher. If we look at the offers, 63.7, this option is 63.8, this is 63.2, so the offer is also higher. So now we got the bid and the offer higher on both sides. So this what we would call like a faded market, right? We got the bid increased and the offer kind of faded up relative to the corresponding options. So in this case, we're seeing that it appears that there is an implied volatility bid in that option where somebody put in perhaps a pump, or there was a market maker that put in a pump into their IB, or it could be a resting order. But that's kind of one way to detect it quickly with your eyes, right? So that's something maybe to look at if you're looking to do an option in a call, like around these strikes, which were a little bit below at the money. We could look at the with strikes above. Here's strikes that are above, out of the money. And what we see here are some implied volatility. So the white colors, remember, that's the indication here that we're detecting some kind of a lean. So let's come up here. So here's a detection of an implied volatility lean on the ask, which is indicating that there might be something going on the offer side of this option. So one thing we see is that you can see that the bid and offer are 5 cents apart, right? So here's it's 5 cents apart. The bid and offer with the option below is 10 cents apart, right? This is from 555 to 565, you got 10 cents. The option above that is 10 cents. From 430 to 440, that's 10 cents. But this one's 490, 495. So that sticks out a little bit. The market tightened up here. So which way did it tighten up? Well, here we could see, if we're just looking at the bids, we start at 64.4 on the strike below, then we move down to 64.2 on the strike above, then we go to 64.1, the strike above that. So that looks kind of like smooth, smoothly declining between those three. But here we notice that we go from 64.7 down to 64.4, back up to 64.5. So this is a little bit jagged, right? In the markets, if you guys, if you draw a distribution curve, is smooth, right? It doesn't look like jaggedy like this. So that implies that something perhaps is there on the offer. We don't know if it's a resting order. We don't know if it's a pump. We don't know if it's a market maker, but something there is saying that perhaps there's an interested party there in that option coming in from the ask side. Okay, so that's really quickly. If we scan with our eyes, we see where those implied volatility leans kind of pop out. Right, here's one in the puts, on the ask. Here's one in the bid. Sometimes the implied volatility lean could be, more dramatic. These aren't very dramatic, but we're also looking at Tesla here, where there's a lot of trading, and so these aren't as dramatic, the markets, but it could also kind of point to why there's a vertical skew based on the leans and the trading going on. So what about a spread? Well, here's Tesla's 244, an out of the money call spread. If you're looking at it, well, here's a lean on the bid, 63.3. Here's a lean on the asks, 1185. That kind of implies that, well, you have a bid in this option on a relative basis. You have a offer on this option on a relative basis. So that could present a credit call spread if somebody's looking for potential credit call spreads, where you have this $10 credit call spread where it looks like it tightened up, on the bid on one side and on the ask on the other side, which could present another perhaps trading opportunity. What about a bull call spread? Well, here's one where we see at a 255, we see a lean on the ask of 62.8, and right above that, the strike, the bid is 63.1. So that perhaps, you got a 255, 260, right? So I'll just bring this up what it would look like. You click on the 1690, right? Buying the 255, and then you click on the 260, selling the 260, you run it. So there, this is a debit of 195, right? So you could see midpoint 185, but that would be something that perhaps you could even negotiate better, because you see that there's what appears to be an interested party on the sell side from one side, and then an interested party from the buy side on the bid side. So that's one way to perhaps look at opportunities for spreads. And of course, it doesn't have to be just vertical. You know, you could go from one expiration, come out to a different expiration, and do a horizontal spread as such. So that's another way to look at it. Risk reversal and so forth. So these are just pointing things out that there are markets out there, and perhaps something there is on the books, or something there has a pump in there, and this just draws your visually just draws your eyes to quickly assess maybe there's an opportunity or not. Okay. Let me come back to the November, and keep in mind we're on Tesla, so there are a lot of these going on right now. Because Tesla trades a lot. There's a lot of trading going on. In calls, puts, different strikes, different expirations, and so forth. So we're going to see a lot of them in stocks like this. But let's see if we look at the most active calls. So most active calls are the 245. So once we detect the most active calls in this expiration, we could kind of get an idea, well, what might be going on here. There's 5,100 calls that traded today. And what we see is that it looks like there's an implied volatility lean on the bid, right? This is the bid side. So that may indicate that, there's a lot of trading and maybe a demand coming in from the buy side on balance. Now, there's trading going on, buyers and sellers, but it looks like perhaps there's a more lean towards the buy side. Let me look at the put. Okay, the put, the same thing. So the put, the 245 put is the most active in this expiration. So it happened. The call and the put are both on the 245 strike, most active. Here, if we look at the put, that looks like the implied volatility. There's also an implied volatility lean, and that's on the bid side too. So both of those so far look like there is an implied volatility lean coming from the bid side. All right, here's 63.2 in the put, 63.4 in the call. So I'm going to just click on this for a second. I'm going to click on the call, and I'm going to run this analysis. And what we're going to do is just take a look at, I'm going to jump to the chart. Okay, so I'm going to go here, summary. I'm going to go to this chart. And what this chart now is showing me is it's a chart of the price and implied volatility of this particular option. Okay, so here we see the price, how the price changed throughout the day. And here we see how the implied volatility changed throughout the day for this particular option. So the implied volatility kind of started up here, went down, stayed steady, maybe climbing up a little bit. So we know that there's an implied volatility bid right now, right? When I clicked on it, we know right here there's an implied volatility bid with 5,000 contracts. But was it there all day? Did it change? Was it maybe on the offer in the morning? Did it change to the bid later on in the afternoon, or did it go back and forth between offer and bid? Did it tighten up on both sides, right? So we know how this one looks. That's just the one snapshot that we're looking at. But what if we wanted to track it throughout the day, because there were 5,000 contracts that traded there? So let's look at that. So I'm going to slide down here, I'm gonna look at this implied volatility. I'm gonna say, show me the implied volatility leans. You see right here? So we're gonna click on that. And the B stands for implied volatility lean on the bid. If there was an implied volatility on the ask, I'm gonna show you the stats here. It would show an A, and if it was both, it would show B and an A. So here are the stats. All day from our snapshots, we detected the first implied volatility bid around here, like 10:15. And it looks like throughout the day, every time we took a snapshot, every 5 minutes, there was an implied volatility bid lean, which kind of like shows how this, you could see here that IB is now increasing, which would make sense. It came in here and it was kind of increasing all day. So out of all our snapshots today, we detected that there were 34 snapshots where there was implied volatility lean on the bid side, 0 on the ask. So what this has shown us that it was pretty persistent throughout the day, that the markets looked similar to what we're looking at right now throughout the day, where there was an implied volatility lean on that bid. Okay, and let's just take a look at the trades. So I'm overlaying the trades, and you can see that not only was there a lean in the market on the bid, you know, those gray bars are showing that there were trades going on in that option throughout the day. All right, so that's where we're getting, you know, the volume and the implied volatility being combined. So that gives us a little bit more insight that what we're seeing right here, that snapshot was persistent throughout the day today. Jeff, we're right with 20 minutes left. So if you have questions, I think I'll just go ahead and start taking them now.
Yeah, D, it's me. I'm in. So we do have. Sorry about that. I ran into some technical issues. We got a question from Mike Chandler. He was asking, how rapidly does IV change with stock price change? And is it the same when IV is rising or falling? It seems to fade slower than it rises, and often over several days.
Yeah, so I mean, the implied volatility itself, you know, I'm trying to think of how the question when you're a market maker or dealer, right? Like a market maker or dealer, you have what's called streaming quotes. Your quotes have to continuously update. Okay, so you can't leave stale quotes out there if the stock's moving. You have to continuously update and refresh your quotes. And part of that refresh is due to the fact that you have a moving underlying. Right? So if the underlying moves, your options are moving along with it because they're repricing. And usually those repricings are based on some kind of implied volatility that you assign the option. So it will work backwards. If you want a 63 volatility, right, then, and you hold that 63 volatility, well, as the stock moves, your price will change. So even if the stock price moves down, a call will be worth less, even with the same implied volatility, right? So the 63 volatility is pegged based on where the stock price is. So you can maintain the same implied volatility, but the price of the option will change as the underlying changes. Okay, so that's how you're recalculating and refreshing your quotes, you know, based on those implied volatilities. So does the implied volatility, I guess, change? You're saying, like, is the implied volatility change a lot? Well, we just looked at this graph here. Here, let's come back. Or do I have it up? So this is how I'm going to remove the trades. So over here, this is shown the implied volatility Up here is the price of the option. So you see the price of the option is changing, but so is the stock price. So you can see here the stock price is changing and the price of the options is changing. So, but the implied volatility is also changing here. So you got lots of dynamics going on, right? Even if we had this same implied vol across, a straight line, even if you had a straight line, same implied vol, this price would change because the price of the stock is changing, okay? So what if we just isolated implied volatility? It doesn't matter where the stock is going. We just wanted to know what the implied volatility of the option is doing, okay? That's what this graph over here is, the implied volatility. That's what this is showing, that what the implied volatility did throughout the day. These are different snapshots, and I'm going to take off the leans for now. And here what it shows us is there are 3 different lines, okay? One is the midpoint implied volatility. Since you have a bid IV, you have an ask IV. Well, if you just wanted one line, right, to represent the value of that IV, we would take the midpoint, because the midpoint is what we call the mark to market, right? That the fair value is somewhere between the bid and the offer, so we take the midpoint. And that's because the option value changes even without a trade. The option value will change because if the stock goes up, well, a call option is worth more. Even if there are no trades, it's just worth more. If the stock goes down, well, the option is worth less, even if there are no trades. It's worth less. So how do we know what it's worth? Well, we see the bids and the offers, right? The bids and the offers are changing. So we know what people would be willing to buy it at. We know what people will be willing to sell it at any given moment. So it has to be worth something around those values, between the bid and the offer. So if we just gave it one mark, we'd do the midpoint, the mark to market. So that's what this solid blue line is. But that doesn't tell us the whole story, because you could have a midpoint with a very wide market, or you could have a midpoint with a very narrow, tight market, right? The same midpoint, right? So we need to see the implied volatility of the bid and the implied volatility of the ask to see how far apart they are. And we could see even, do they move further apart? Do they come closer together throughout the day? Do they fluctuate? So that maybe that's what the question is, like, how much does it fluctuate? So now we have all 3 in front of us. So here we could see that in the morning, it was, so the bid here, this is like this red kind of burgundy line. Then the offer is this other dotted line above, right? So that would be the difference between the implied volatility bid and offer. So we could see throughout the day if it changes, if it widens out, if it narrows, if it narrows to one side, we could see that from here, and just eyeballing it, looks like, it was a little bit wider in the morning, then kind of narrowed as we went on. There was a couple times it widened out a little bit, but nothing crazy today. Like, we don't see it, the bids and offers blow out, and come back in. They kind of look pretty steady, versus each other. Like, there's some fluctuation for sure. It's not like, even eyeballing it, you could kind of tell like where there's areas where they're wider apart and narrower apart, but nothing crazy according to this chart.
All right, thanks. Is there a delay in the option table IVs we should consider in lean evaluations?
Well, of course, when you're, if you're looking at a delayed, right, delayed quote, that doesn't necessarily mean that right now there's a lien. So you would have to, look at it if you're looking at a real time. So for sure you'd want to still compare it. But you could see here, there's a lien all day in this option, right? And maybe perhaps in this one. So this is more of an evaluation on, on what's going on today in general, where you could look at the chart, look at the trades, or see where the, last delayed quote was.
All right, perfect. We did the last two questions revolve around the IV chart. He was asking it about it, then you showed it.
Yeah.
He's asking how far back does the chart history go on call IV and I guess put IV.
Yeah. So keep in mind, this is tied to a particular option, right? So this is going for, this option over here. What did I bring up? I think the 245 call, right? So this will go back to, I don't know. Well, this option looks like it's been around for a while. Sometimes a particular option, it could be there a weekly. Sometimes, you could have a 0 DT. So this one can go back, let's see, we could go back. I'm just going to go back a week. So let me see. So that might have been a bug, but it will go back to, where the option first started. So let me see, I might have a bug in there right now. So let me try October 3rd. So this is here, October 3rd. So you can see here, I'm just going back in time. Let me see if I could go back further. So here's like from September. So you can see here, the implied volatility since then has been increasing, right? It started like around the 58, now it's at the 62. So when you're looking at a particular option, we're going back in time since its inception. So if it didn't exist 2 years ago, well, there's no implied volatility to that option. It didn't even exist. So this will go back from the time that this particular option started trading. And of course, once the option expires, it goes away, right? So October 11th, these options will expire. October 11th, they go to parity. So moving forward, there's no more implied volatility for that option because it will have expired.
All right. Well, that's it for the questions, D, unless anything pops up in the next couple seconds. Actually, nope, nothing else has popped in.
Okay, well then let's just stop there. I mean, we only have a couple minutes left.
Excellent job, my friend.
Yeah. All right, thank you for the questions, everyone.
Great job, Jeff, as always.
Yeah, no, this was great. Again, thank you guys for coming by. Looking forward to, for our listeners, Will and Dimitri are going to swing by the IBKR podcast studio later today, and we're going to take a little bit of maybe a different dive, I would say, not a deeper dive, a different dive into the subject. That podcast should probably be released most likely on Thursday. And, as always, remind everyone that you'll get a recording of this webinar. You can go on our website, go to education, go to IBKR campus, look for past aired webinars from all our contributors, and especially Market Chameleon, who's kind enough to come by once a month and go over important option topics with us. So guys, always a pleasure. Thanks again.
Great, Jeff. If anyone else has outstanding questions that happen over the next 24 hours, they can comment to our morning show on the YouTube channel, marketchameleon.com. Just go on to YouTube. We have a live morning show every morning for anyone who has any questions. Thanks, Jeff.
Thanks.
All right, thanks, guys.
Thanks,
Until next time. All right.
Great day.